This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you daily with short business episodes, short private equity episodes, and a lot more. If you ever have a topic to suggest or you want to be a sponsored guest on the podcast, feel free as always to text Scott Becker 773-766-5322. Today's concept comes out of a lecture we're giving on investing to younger people. So we're going to work through essentially a couple of different pieces in this. One piece is titled 5 Pieces of Advice for the New Investor. One is titled 9 Overriding Rules for Investing. And we'll start with one and go to the second. But let's start there. And Janelle and I will come up with a title for this podcast shortly. The first starting piece of advice for an investor, and these are 5 rules for investing. First rule is, in the long run, putting away as much money as you can, as often as you can, is generally the key to long-term being successful in building wealth. So put away as much money as you can, as often as you can. That often means putting away 10 to 20% of your paycheck every single time. There's an old concept, pay yourselves first, and doing that constantly over a long period of time. Also, you need to keep your spending in check enough so that you can largely put away money every year, every paycheck. And it's not that there's not going to be emergencies, not going to be problems, but in the long run, if you want to build wealth and you don't start a company and sell it, you better find a way to put money away constantly. Second, if you have an employer-sponsored retirement plan, you should max out on it, both for 2 reasons: tax deferral, and often the employer-sponsored plans are matched by the employer, and that's essentially free money that you take in that you would never get otherwise. Third, people ask me what stock to invest in, and I say, don't find a stock, find an index fund. Find an index fund. Make one of the S&P 500 index funds your core investment tool. Look for low expenses and look at index funds as your starting point on investing, not individual stocks. And we'll talk about that later in a separate discussion. The fourth rule we have for young investors and really long-term investors is to know your allocation of stocks to bonds to cash. At the end of the day, this allocation is so important to being able to sleep at night when the market goes in the wrong direction and to making enough money in the upside when the market's going in the right direction. But you have to spend time really drilling down on what allocation works for you through good and bad times. The fifth rule, and it relates to, again, the fourth rule, which is knowing your allocation, is don't stress out day to day. If you're like me, a neurotic person who can't help themselves but look at the market all the time, that is what it is. But you better have the proper allocation of stocks, so even if you look at the market all the time and can't help yourself, that you know you're okay and you can breathe. So those are the starting 5 rules of investing for a new investor. The second part of this discussion is 9 overriding rules of investing. And some of these will very much mirror some of the additional 5 rules of investing. So the first rule of investing, and this is something I preach constantly, allocation is everything. So allocation to stocks, bonds, cash, what is going to be your percentage of allocation to each is everything in terms of being a long-term investor. And this may change over time, but you need to study allocation principles and understand them to be able to breathe through ups and downs, live with the downs. Second, you have to understand what you're investing in. Every once in a while, I invest in something that's opportunistic, and somebody asked me to invest in it, or I read something about it, or somebody called me and said, oh, this is the next great thing, and I invest in it. I will tell you, if I haven't really taken the time to study and convict myself on those issues, the places where I invest and don't really understand it are almost always bad investments. You can get lucky once in a while, but it's a horrible investment plan and strategy. The third concept is, for investing, develop a core plan for investing and define what your core investments are. For me, my 2 core investments are an S&P index fund. Mine largely is out of Vanguard, and then treasuries. Those are the 2 core investments. Then on top of that, I want to have an emergency fund. And then I've got different stocks and private equity funds, different things I invest in. But make no mistake, my core investments are the S&P index fund and also the treasury bonds. I also have a big investment, of course, in the company that I own, but that's a totally separate issue. Fourth, assess whether to use an outside advisor and how to use the outside advisor or manager. Most people choose to use an outside advisor, and the only thing I can tell you is that's a fine decision, but you have to be careful because most of them are no more gifted than you or I. Fifth, and this goes back to allocation, is you need to understand your own temperament for investing and ultimately the distinction between what we call behavioral finance and financial results. So your temperament for investing drives whether when the market tanks, whether you sell out of it. And of course, this is the worst thing you can do as a long-term investor is selling into the dips. But if you're over allocated in equities, it's very hard not to. If you don't have enough of an emergency fund, it's very hard not to. There's also this big distinction, behavioral finance, how you actually react versus long-term analytics. Long-term analytics would say, keep 100% of your money in stocks for the next 50 years. But most of us know that temperament because when things go down aggressively, we want to sell and then we miss out on the gains when it comes back. It's very, very hard to time the market. The sixth rule we talk about investing is develop clarity about your own investment goals. Are you trying to hit out of the park and turn 10,000 into 2 billion, or are you trying to steadily grow your piece of the pie? I'm a steadily grow the piece of the pie person, but you have to know what you want to do. Seventh, this is one of the cardinal rules we live by, is never borrow to invest in stocks. This is a never, ever rule. Like there's categorical oughts, categorical don'ts. Borrowing to invest in stocks is really the cardinal rule of something not to do. Never buy in margin. That's when you see in the 30s, 2008, other times more recently, people jumping out of windows because they had bought stocks at margin and then the stocks got killed. That's when you see suicides and horrible outcomes. Don't ever borrow to invest in stocks. I'm also a big fan of lower leverage regardless. The eighth thing that we talk about is understand all of your assets and how they impact your portfolio. So if you've got if your intention is to have a portfolio that's 50% stocks, 50% bonds, but you own a company and that company's worth 50% of your assets, then you've already got a lot of your assets in what is really equities. And so you might want to be much more careful with the rest of your portfolio. You really have to understand all of your assets and how they impact your portfolio, not just the piece that's liquid and publicly traded. So if I have a ton of money in private equity funds and venture capital funds, which I don't, then I would have a lesser amount of money in public equities because I want to have enough money in cash and bonds for the sort of ballast safety part of my portfolio. The ninth rule of thumb for investing, and again, everybody's different on this. This is me and how I view the world, is ultimately a bias towards safety. We're big fans of ultimately having a bias towards safety in our investing. And that means for me, probably an over-reliance on treasuries and an emergency fund, where most people would say I'm over-investing in those things. Again, it's listening to the Becker Private Equity and Business Podcast. At any time you have a topic, feel free. Text Scott Becker, 773-766-5322. Or in contrast, if you have a sponsored guest you want to put on the podcast, feel free again to text me and we'll get you our sales team. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you very much.